As a beginner investor, you may be suffering from a behavioral bias when deciding in what to invest. A hedge fund, an index fund, crypto, gold. It is human nature to be biased, especially when a person is shown a particular graph or promised high return with very low risk. I stumbled upon this lecture from the MIT professor Andrew Lo on artificial intelligence in finance. As an engineer, I'm naturally curious about fintech innovation, but this particular part of the lecture applies to everyone. The professor lays out quite an interesting example that I want to share with you, and you can test yourself in a way. How would you go about investing? I think you'll learn something about yourself as an investor in the next 5 minutes. Let's dive right in. Welcome to another quick video of Investing with Kurt. Today we're looking at how investor behavior can be tricked by looking at charts and graphs which are not necessarily indicative of a good investment. Let's take a look at the quick example from Professor Andrew Lo and see which line or which investment asset you would pick with the lack of necessary context and knowledge.
But a number of economists and psychologists came up with all sorts of other behavioral biases that humans seem to suffer from. And I won't take you through all of them, but I'll give you a very simple example that I think we all face every day in terms of how we decide on investing. My first-year MBA students are confronted with this problem in the class that I teach and try to motivate how to think about investing. I show them the returns of 4 different financial assets. I don't tell them what that is or even over what time period they span. I simply show them what the rates of return are for $1 invested in these 4 assets over an unspecified multi-year horizon. And this is what it looks like. The green line turns $1 into $2 over this multi-year investment period. Not very rewarding, but not particularly risky. It's got a pretty smooth upward slope. Red line turns $1 into about $5, way more rewarding, but way more volatile, lots more risk. The blue line turns $1 into $8, even more rewarding, but way more volatile. And the black line, somewhere in between. And the question that I asked them is, if you could only pick one of these 4 assets, you can't mix and match them, you could only pick one to put your entire retirement wealth, or your children's college fund, or your parents' or grandparents' life savings, if you could only choose one of these, which would you pick? It's a matter of risk versus reward, right? So how many of you here would pick the green line? Show of hands. Anybody? Wow, nobody? Well, maybe one person, but okay. How about the red line? Anybody, any takers for the red line? Really? Only one person? I want you to remember this moment, because when I tell you what the red line is, some of you are going to need to call your brokers. The blue line. Any takers for the blue line? Okay, so these are the entrepreneurs and hedge fund managers. Yeah?
Do I see the graph?
What's that?
Do I see the graph, right?
You see the graph?
Like when I make this call.
Yeah, absolutely. Absolutely. You see this whole thing right now. And I'm asking you right now, yeah, you see the graph. Do you like that? Okay.
Let me stop here for a moment. I want to give you a quick second to think about which line or which asset you would choose. Are you the blue line, the red, the green, or the black line? I'm really curious to know what's your pick, so pause the video for a second and put your picks down in the comment section. I really want to know what's your reasoning for the asset that you chose. Alright, now back to the video.
Black line. How many people want black? Yeah. Virtually all the audiences that I've talked to way prefer the black line. Why? Because it's got the best trade-off between risk and reward. It's not the most rewarding, but it seems to have pretty low risk. Well, let me tell you what you all picked. First of all, the time period goes from 1990 to 2008. Okay? The green line is US Treasury bills, the safest asset in the world, at least for the next few weeks. We'll see what happens with the budget discussions. But not very rewarding. So if you put your money in T-bills, you would have earned pretty much next to nothing over the course of the last decade. The red line, which only one of you picked, That's the S&P 500, the US stock market. Most of you already have that in your 401k. So if you didn't pick it, you need some rebalancing to do. But if you did pick it in 2008, congratulations, you did just fine. You did quite well. The blue line is a single company, Pfizer, pharmaceutical company, way, way, way more risky. Not for everybody, but for the few entrepreneurs and hedge fund proteges, makes sense. And if you put your money in Pfizer, well, congratulations, you did even better. Exactly. Phenomenal. Now, what about for the most of you who picked the black line? The black line is the return to a private fund known as the Fairfield Century Fund. This was the feeder fund for the Bernie Madoff Ponzi scheme, which is why I had to stop it in 2008. That's when the Ponzi scheme blew up. Now you know how the Ponzi scheme got as big as it did. Look at the number of hands that went up. It is human nature that we are all drawn like a moth to a flame to high-yielding, low-risk assets. And in finance, we have a term to capture that phenomenon. It's called the Sharpe Ratio. The Sharpe Ratio is defined as the expected return above and beyond T-bills in the numerator and risk as measured by the volatility in the denominator. So what you could think of it is the amount you're earning per unit risk. And we all want more. We want more Sharpe Ratio, higher Sharpe Ratios. And if you look at Pfizer and the S&P 500, the Sharpe Ratios are about a third compared to the Bernie Madoff Ponzi scheme before it blew up. It had a Sharpe Ratio on paper that was an order of magnitude higher. Sometimes when things are too good to be true, they aren't true. Now, there's nothing patently irrational about seeking high Sharpe Ratio assets. But the problem is that our perception of risk is highly subjective and context dependent and can easily be manipulated. And as a result, human behavior does not always give us the best financial outcomes. But unless we understand why we do the things that we will later regret, we can't develop the algorithms to get around it and to do a better job. That is, after all, what AI is supposed to be about.
All right, I hope you paid attention to the last bit and the explanation. Let me just echo a couple of key points that Professor Angelo made. People love and seek high yield and low risk assets. Or that's why we've got Sharpe Ratio and we all want higher Sharpe Ratio. However, our perception of risk is highly subjective and context dependent. We can easily be manipulated, and that's why I always say don't trust mainstream media and in particular financial TV channels, as they know how to manipulate you. They want to make money for Wall Street, not for you. They're not your buddy. So a second point that the professor makes is that human behavior does not give us the best financial outcomes. This is why you hear me mention in my videos that to be successful in investing, we need to set aside our emotions and try not to necessarily rationalize things or time the market. Rather, we want to have an investment plan, a determined asset allocation that matches our risk tolerance, and simply execute the strategy for long-term investing. That is the key to success. Alright, thank you guys for watching. I hope you learned something new today on investing. If you enjoyed the video, make sure to destroy the like button, and as usual, if I missed anything, drop it down in the comment section below. And if you're new here, please subscribe for more videos and real investing advice. Check out some of my other videos from my investing playlist where I talk about the most important topics and teach you what to do. So, until next time, stay the course and keep investing on a regular basis.